Today, we're heading into some pretty treacherous territory in the investing world, penny stocks. Now, this place is a total minefield of risk. But for some people, the chance for an explosive reward is just too tempting to ignore. So think of us as your guide. We're here to give you the map. So here's the big question, right? Are these super low-priced shares some kind of secret shortcut to getting rich? Or are they just a fast track to financial disaster? That's exactly what we're going to unpack in this explainer. Let's get right into it.
All right, first things first, what are we even talking about here? Well, a penny stock is pretty much what it sounds like. Almost. It's a share that trades for less than $5. You're not going to find the big household names here. These stocks usually trade on what are called over-the-counter, or OTC markets. Think places like the Pink Sheets or the OTC Bulletin Board.
Okay, let's talk about the gamble, because that's really what it is. This isn't just about a stock having a low price tag. It's about the kind of companies that are behind these stocks. So why are they so risky? Well, for one, these are often tiny companies. They could be brand new, drowning in debt, or even on the brink of going bankrupt. And here's the huge problem. There's a serious lack of reliable information. A lot of these companies, especially the ones on the Pink Sheets, don't even have to file financial reports with the SEC. So trying to make an informed decision, it's incredibly difficult. And this combination of mystery and light regulation, it creates the perfect hunting ground for scammers. So let's crack open the scammers' playbook and expose the traps they set in this wild west of investing. The pump and dump. This is the absolute classic. Here's how it works. Promoters will start hyping a stock like crazy, sending out emails, posting on forums, you name it. As unsuspecting investors buy in, the price gets artificially jacked up. That's the pump. And then, once it's high enough, the scammers sell all of their shares for a massive profit, and the stock price completely crashes. That's the dump. And it leaves everyone else holding the bag. And then you've got the opposite scheme, the short-and-distort. This time, scammers are betting the stock will fall. So they borrow shares and sell them, and then they unleash a flood of fake negative rumors about the company. The goal is to create panic. As investors sell off, the price tanks. The scammers then buy the shares back at the rock-bottom price, return them, and pocket the difference. It's just as nasty. And believe me, the list goes on. You've got reverse mergers, where shaky private companies go public through a backdoor to cook their books. You've got so-called gurus selling you their worthless secrets for a fee. You even have offshore scams pushing unregistered foreign stocks on people. It really is a jungle out there. If you want to see just how bad these scams can get, we need to talk about one of the most infamous examples in history, the Bre-X mining scam. I mean, this says it all. Back in the mid-90s, the founder of this tiny Canadian company, Bre-X, claimed he'd struck gold, literally. He said they'd found a massive gold deposit in Indonesia. The whole thing was a complete and total lie, but wow, did investors buy it? Hook, line, and sinker.
And the result? Absolutely devastating. As the hype went into a frenzy, Bre-X's stock price exploded. But when the fraud was finally uncovered in 1997, the company collapsed, and 3 billion Canadian dollars of investor money just vanished. A staggering loss, all built on a lie.
Okay, that was the big cautionary tale. So how in the world do you protect yourself? This is where you build your own shield. It's time to talk about spotting the red flags. The very first thing you have to do is learn to tell the difference between a paid promotion and real research. Promos are going to use crazy language and insane predictions. You have to read the fine print. If the person writing it is getting paid by the company, it's an ad, it's not analysis. Real research is objective. It's about a company's fundamentals, plain and simple. Next up, you need to know where the stock actually trades. The OTC Markets Group breaks companies into different tiers based on how much info they're willing to share. OTCQX, that's the top tier. They have the highest standards. OTCQB companies, they're up to date with their SEC reporting. But then there's OTC Pink. That's the bottom tier, and the reporting there can be spotty or just not exist at all. The lower the tier, the higher the risk. Period. Okay, listen up, because this is important. If you're ever looking at a stock and you see a skull and crossbones symbol next to it, that means caveat emptor. It literally means buyer beware. This is the ultimate red flag, a direct warning from the OTC markets themselves that the company might be a target of spam or even under investigation for fraud. So, you've seen the risks, you've seen the red flags. If, after all that, you're still thinking about dipping a toe in these waters, you absolutely 100% need a survival guide.
Here are 4 rules to live by. First, limit your exposure and keep your portfolio diversified so one bad bet doesn't sink you. Second, check the stock's liquidity. You need to make sure enough people are trading it so you can actually sell when you want to. Third, always have an exit plan. Know when you're going to take a profit or cut your losses. And finally, even in this crazy market, try to seek some quality. Look for companies with a real product and honest leadership. Let's just hammer home that first rule because it is by far the most important. Look at this chart. Penny stocks should never, ever be the main part of your portfolio. They should only be a tiny little sliver. We're talking maybe 1 or 2% tops. This is money you have to be completely 100% prepared to lose. All right, we've walked through the landscape, we've pointed out the traps, and we've laid out the survival rules. So what's the final verdict on this high-stakes gamble? You know, the source material on this is pretty blunt. When you add up the potential for fraud, the severe lack of information, and the wild volatility, you're looking at a massive gamble. And for most people, the odds of winning might genuinely be better at a casino. So let's just recap the biggest takeaways here. Number 1, penny stocks are by their very nature extremely high risk. 2, this market is absolutely flooded with clever scams. 3, your only real protection is doing your own thorough independent homework. And finally, if you do decide to speculate, you have to follow strict rules and keep your exposure incredibly small. And that brings us right back to where we started. We've laid out the minefield and we've given you the map. Now that you've seen the terrain and you know the dangers, you can make a much more informed decision for yourself. So, is the gamble worth the potential reward?